like to thank everybody for this excellent streaming. I also would like to thank Aswath Damodaran and the translator, Mr. Unutmaz, and you, the broadcasters, and also the Gedik investment shareholders for all their help. Of course, we are very excited, and we are very happy that we're celebrating 30 years in capital markets. For 30 years in the capital markets, Gedik Investment has organized hundreds of trainings, and with 420 employees who are located in various cities in Turkey, we contribute to financial literacy by discussing how financial literacy can be enhanced with the potential investors and our clients. We try to raise awareness, we try to raise the level of knowledge and financial literacy in the country. Well, specifically those two books you have sponsored by Aswath Damodaran, why do you think it's important to read them? How would they contribute to financial literacy? Well, that's an excellent question. And at this point, I'd like to emphasize that we're honored and privileged to be the sponsors of those two very valuable books by Professor Damodaran. First of all, let's discuss the valuation book. The valuation book is such an asset that it will help a person who's never invested in any stock or any paper in the capital markets, will be able to understand how things can be valued. So after I read this book, I said this has to be translated into Turkish. And I think that it has contributed greatly to the enhancement of financial literacy. And then the second book that we've sponsored is Narrative and Numbers, which is an excellent book that teaches us how we need to be diligent in not only examining a company from the point of view of its numbers, but also from the point of view of its narratives. So one is a book that tells the numbers well, and the second book is the book that teaches us that it's more important to have a balanced view of the numbers and the story, and not be blinded by the numbers only. So not only one, but both of these books have to be read. Well, finally, Mr. Topaç, you also stated that it's your 30th anniversary this year as Gedik Investment, and congratulations, it's quite a long time in capital markets. You've also explained how you've contributed to financial literacy. But into the future, what are your plans and actions to improve it further? We are celebrating the 30th anniversary of Gedik Investment, and we hope that we'll be able to survive many 30th anniversaries into the future. We are the most experienced and dynamic team in the industry, and I'm proud to be the CEO of this entity. And our vision is very clear. We want to be the leader in all the markets in the sector. We also want to invest in the startups so that we can help young entrepreneurs, and also to help gender equity by giving a priority to women entrepreneurs more. So that's how we are planning to make our investments, and we are improving financial literacy both by educating the investors and by with the publications we're sponsoring. Thank you very much, Onur Bey. Now, Professor Damodaran.
Hi, how are you?
Hi, fine. Thank you for joining us. And my first question will be the process of broadcasting your book, actually. And we know that Scala Broadcasting, actually Scala Publishing, is celebrating its 30th years in the sector. So it's a long term, we can say, for the publishing establishment in the sector. So how was working with them? Can we have your feelings and the process? How was it? And are you happy?
Yeah. I've written a dozen books and I have 5 different publishers. And my definition of a good publisher is you don't even notice they're there. And from that perspective, it was extraordinarily painless. I didn't even know who my publisher was till I was told. And that is healthy, because when a publisher is constantly telling you what to do, as a writer, that can only get in the way. So Scala was incredibly easy to work with. And the fact that we had a great translator in Ergun, I think made a big difference. So from my perspective, I did almost nothing. And that's a great place to be if you're a writer.
Okay, so I hope your book will be very fast successful as as all the book you have. So now, şimdi Ergun Bey'e sözü veriyorum. Now the chat is you, Ergun, with Professor Damodaran. You can ask your questions.
Thank you, Arzu, and thank you very much, Onur Bey, not only for this speech and just for all the financial contributions to this financial literacy in Turkish. And dear Professor, it's good to have you here again, and thank you very much for making room for this conversation. And I know you are very busy, you have plenty of programs and Zoom meetings and other students to handle with, but it's good to have you here. And I'd like to start with actually your previous book, The Little Book of Valuation. This was a great book, and it's actually, the work was done in 2020, but it came to the market at the beginning of the year. And I know you always say that basic valuation is common sense. And in this book, you have showed it to everybody by far a great margin, how this book is simplified. But the most questions I get, that's great. Most questions I get, I miss the links, the people say. So according to me, your book is a compass for professionals and it's a beacon for novice. So how do people make this bridge?
That book is about, the original version of the book in English is about more than 10 years old. And I wrote it because my original books on valuation were meant as textbooks, as practitioner books. They ran into 1,000 pages. And let's face it, the average investor doesn't have the time to read a 1,000-page book on valuation and shouldn't be doing it. So John Wiley was the publisher of my original book, came to me and said, would you be willing to compress what you did in that big book into a little book? I said, sure, because my definition of when you understand something is when you can compress it. I tell people my life's ambition is to take my entire valuation class and be able to summarize it into a 5-minute session. Because if you can do that, then you truly are getting it. So I've always found that people who spend days explaining what they do really don't understand what they do. Because if you truly understood what you did, it shouldn't take you days to do it. I'm not quite to the 5-minute level yet, but that little book was my attempt to say, look, I can take what I know and tell it in fewer words. I'd like to create an even littler book on valuation, it's even fewer words. But the intent here is to bring in the core message of what I was trying to deliver in my original valuation books without diluting it just because you're a retail investor or a novice investor. I didn't dumbify the book. I mean, a lot of people said, well, why don't you just take out the big ideas and just make it a manual? That's not my objective. Everybody can think for themselves, whether you're a retail investor, a professional investor, somebody's starting out, or somebody's been doing this for decades. I want to give you the tools to be able to think for yourself. And what that book does is it lays out the first principles, but then it says, look, you're a smart person. You can think for yourself. Now think through a way in which you can answer this question. So hopefully that's what it does. But if it doesn't, then I've got more work to do.
And in this point, I actually suggest people, please do it twice. First reading is just to exactly comprehend the notion that you have given us. And there are gaps between, for example, accounting. Accounting is different for the calculations, but you also give a base for accounting and our understanding changes. So I think people should at least twice read this book, once for understanding and a couple of months later with other books, with other calculations, it would be better.
And I would add one more thing, which is don't read so much. After you finish reading, do, because you learn valuation by doing, not by reading about it. So if all you do is read the book over and over again and you never do a valuation, nothing's going to stick. You're going to forget everything in a minute, 15 minutes, 30 minutes after you read the book. So read the book and then try to value a company. Use the book as a guide, as a crutch to value the company, but value a real company you're familiar with, because that's the only way you really master valuation is by working on your valuations.
And in this point, can we make it the subject a little bit broader? I know you always said valuation is a craft. It's not art, it's not science, but it's a craft. Why does it is a craft with this concept?
Yeah, I give the analogy to cooking. You can read about cooking, you can watch TV shows about cooking, but to learn cooking, you've got to go into the kitchen and start cooking. Because the first time you cook, nothing works. But every time you cook, you learn something new. The same thing applies in valuation. You think you understand valuation when you're reading a book or watching somebody talk about valuation. But until you actually do valuation, you really don't realize what's sticking and what's not sticking. And each time you value a company, you will learn something new. You're getting better at your craft.
Mm-hmm. Yep, that's a very good advice. And before finishing with this book, I'd like to read the last sentence of the book. That's a great sentence, and I'll have a question on follow-up. The last sentence of the book is, convert stories to numbers. And ironically, we have, or not ironically, it's not a coincidence, I have already explained in my blog, your next book was Narrative and Numbers. And you have once said that it was the most fun book of writing. And how do we convert stories to numbers?
I mean, first, you need to tell a story before you can convert to numbers. The reason I wrote that book is I think we've lost our way in valuation. A lot of valuation has become Excel spreadsheets and financial modeling, rather than thinking about a business and why a company is good at a business. So that book was an attempt to recapture a lost art, something we used to do in valuation before we had computers and Excel spreadsheets. So because now I think you have the crutch, you use data, you project into spreadsheets, you think you valued a company. And I tell people, if all you have are numbers in a spreadsheet, you don't have a value for a company, you just have a spreadsheet. So what that book basically says is, let's go back and think about what makes a company valuable or not valuable. It's a story you're telling about the company. That story obviously has to be based on the reality of the company, the business it's in, the competition it faces. But it is a story that guides the numbers you have in your valuation. And that's the process that I think we need to work on. I mean, each of us is more comfortable with one or the other, either working with numbers or telling stories. And I tell people to become good at valuation, you got to work on your weak side. Work on that side that you feel less comfortable on. So if you're an engineer, a scientist, an accountant, and you're comfortable with numbers, I want you to think about storytelling. If you're a history major, you're a journalist, you're somebody who doesn't like numbers, but you like to tell stories, I want you to think about numbers. Work on your weak side, because you need both sides working in order to be able to do a good valuation.
And in this point, I'd like to add you one of your another words, sentence that is very impressive for me. A good valuation is a bridge between stories and numbers. I think you said once. And how does this bridge follow the gap between creativity and discipline for these people?
I think what I mean by that is if you show me the valuation of a company, even if it's all numbers, and I point to a number and say, why is that number what it is? The answer I want is a story you tell about the company that explains that number. Whereas if you tell me a story about a company, it's got a great brand name, amazing management, the question I'm going to ask you is, where does it show up in the numbers? In other words, creative people come up with great stories. But if they don't have numbers to keep them constrained, those stories can become fairy tales. You can tell great sounding stories, but they can't happen in practice. Number crunching people often don't like to tell stories, but they're so caught up in the numbers that they can't look at the big picture, what the company can do. So I think in the way I describe it is to be good at valuation, you either have to be a disciplined storyteller or a creative number cruncher. And I think that is why it's so difficult to do valuation, because you often have people who are very good on one side of the process, but not on the other.
Mm-hmm. That's good. That's great. And I should apologize for not thanking you at the beginning of the broadcast. I'm a little bit excited to having this conversation with you. Thank you very much for your lovely comments about the translation work that I have done, not only just for this book, but the previous book too. And I'd like to thank Scala too. They were exactly as you said. They were really good. They were helpful for our wishes, and it ended with these two good books. And Professor, in this point, I'd like to ask you, this is a Theranos story. When I was translating the book, I stopped and started reading about Theranos. So it was very interesting for me. As an investor, I would say, why did people did not check this at the first place? This FDA approval or so what? Why do we investor would like to jump on the story so reluctantly?
Because sometimes we fall in love with the story. We want the story to be true. This is true in everything in life, right? Sometimes there are things we want to happen and we want it so much that we stop asking questions. Because we know that if we ask questions, the story might not come true. And in investing, this can be deadly. You're a story about a business. You like the storyteller, the founder of the business. You want the business to succeed. In fact, you want it to succeed so much that you're afraid to ask the question that you know will cause the concept to fall apart. It's human nature. I don't fault the people who did that, because it's happened for as long as you've had time. You've had businesses where people have invested and not ask questions because they don't want to know the answer. So I don't blame the investors in Theranos for being short-term and not asking the questions. I understand what they did. In fact, I tell people that if it had been March of 2015 and I'd been at that investor showplace where Elizabeth Holmes was making a pitch, I don't know whether I'd have asked the question. I'd be lying if I said, in hindsight, we all say, of course I'd have asked the question. And that's something to remember about hindsight. When you read about a calamity, a scam, a huge scandal, you're always saying, well, I would never have been part of it. Because after the fact, it always seems obvious who would fall for this scam, whether it was Charles Ponzi 120 years ago or Bernie Madoff 15 years ago. We're all convinced that we're all too smart to fall for scams. Don't believe that. We're human beings. We're hardwired to believe things we shouldn't be believing. So I think the reality is that people were being human. I don't fault them for that. And Elizabeth Holmes took advantage of humanity. The one thing I would add is one reason the story sold so well is Elizabeth Holmes also convinced investors that not only were they investing in a company where they would make a lot of money, but that this company was going to change the world, make it a better place. As you well know, I am a skeptic on ESG, this notion that being good. And the reason I'm skeptical is this is the shield that companies use to do some really bad things. They cloak themselves in nobility. I'm doing this for the good of society, for the good, And I think when they do that, it becomes very difficult to ask the tough questions because you're afraid of looking like an evil person. Why would you want to bring up something as pragmatic as making money when this person is talking about saving the world? So let Theranos be a cautionary note when you look at ESG and companies talking about how good they are. Because in my experience, when I've, all the good people I've had in my life, how often the good people in my life talked about how good they were? Never. They did good things, but they never talked about being good. So I think that the reality is that it's difficult, it's costly, it's inconvenient being good. But just go out and be good. Don't try to talk about being good.
Mm-hmm, mm-hmm. Actually, I would just follow up with this ECG because you're a prolific writer, your blog and your YouTube videos, you have discussed that. And I, at the same moment, thought the same thing. One side is making profit, exactly in Theranos' story. And the other side, not to be labeled a person who points out, oh, there's a problem. So ECG was exactly like that. At the moment you said that, I think you had a lot of negative feedbacks on this issue.
I get feedback. It's not negative. People who disagree with me, I don't think of it as negative. I think people disagree with me, and that's fine. I think that's been true for lots of things. Every time I value a company, there'll be people who disagree with me. Disagreement is part of the process. If if everything you write is things that everybody agrees with, then there's something wrong. There's something wrong with what you're writing. The nature of writing about things is you want to provoke discussion and debate. So I'm glad I provoked the discussion about ESG, which might not have been there without my post and my writings. So I don't view that as a bad thing. I think that's fine. And I don't have a thin skin. And I'm completely willing to take on anybody who believes anything that I say and disagrees with it. I'm always willing to kind of debate them and talk about what I believe. But I don't see this, I think it's part and parcel of having an opinion and stating that opinion.
So can we say that when the critics is constructive and it gets into the feeding loop, exactly you did in this evaluation. So you update your narrative and the numbers.
Yeah. And that's why I call it keeping the feedback loop open, because it's really difficult to listen to people who disagree with you and try to adapt your thinking. But I need to keep that door open.
And I'd like to ask one more question about the books, then I'd like to follow on the economics, finance, and valuation side. Actually, this is in the sphere of valuation side, the startups. In this book, I know that the corporate life cycle is the salient issue. And without understanding the corporate life cycle or the company that we are valuing at which point of its life, we cannot make good judgments, as far as I know. And Professor Burak Azrova, as far as I know, Azrova is studying at the moment the first Chicago method. And he would like to know your opinion about this valuation process and specifically the weights of the scenarios.
I'm sorry, when you have scenarios as in, because scenarios suggest that there are only discrete paths. The problem in life is life doesn't fall into discrete buckets. It's continuous. So first, I don't believe in scenario analysis. I think it's kind of a nice way to cover your rear end and say, it could be this, it could be that. But the reality is life is a continuum. And I use Monte Carlo simulations to reflect the fact that you have distributions around the assumptions. So what? Life is full of uncertainty. You still have to make your best judgments based on what you know today. So I think a lot of people use what-if analyses and scenarios as cover for making decisions. And if that's what you're doing, then you're not doing anything productive by running scenario analysis. So if you're running scenario analysis, do it because it's productive. It's feeding into your decision process, leading to a better decision. If it's not, don't waste your time. So I think life delivers uncertainties. All you can do is make your best judgment on how those uncertainties will play out.
But it's plenty in the startups because it's all about uncertainty. Should we calculate a liquidation value or should we hope for a successful IPO? Because the model is not decided yet in startups, I guess. That's the problem.
Why is it a problem? It is the reality, right? I mean, I use this expression all the time in my class and people get tired of it. It's a feature, not a bug. A bug is something you try to eliminate, right? It's a bad thing. Young companies have uncertainty. It's neither here nor there. It's always there. So don't view it as a problem. View it as part of the reality that you face. It's not something you control. I use this term, taking the karmic view, which is there are things you don't control in valuation. Worrying about them is not going to make them go away. So just let it play out and make your best judgments and best decisions and move on.
Mm-hmm. That's good. And if you don't mind, I'd like to continue in general economics, and I have a couple of themes. One of them is risk-free rate. I have tried to explain it in various occasions that if a country doesn't have a AAA rating, we cannot automatically use 10 years government bond rates. And could you please by yourself explain us why is it like that, and how can we link this process to default spreads and CDS when we make a risk-free rate calculation in our valuations?
Well, your starting statement gives you the reason why you can't do it. If your country has default risk, the government bond issued by that country is not default free. If it's not default free, by definition, it's not risk free. The rest then follows. So I think the question that people get caught on is that very first part. Why would a government issuing a local currency bond, why would a government ever default if it's a local currency bond? The pushback is, why can't they just print more money? Because if you print money, you shouldn't default. But here's where it runs into a problem. In the last 50 years, about half of all sovereign defaults have been local currency defaults, where the government chose to default, even though it had the option of issuing or printing more currency. And the reason is simple. You can always print more currency to pay off your debt. But if you do that, you're going to have inflation. So caught between high inflation and default, many governments choose to default. And once you accept that, then the rest comes about. So the Turkish government can issue government bonds in lira, but the fact that they can print more lira doesn't make that Turkish government bond rate a risk-free rate. So I clean up that government bond rate and I do it because I don't want to double count. And what I mean by double counting is if I don't do that, and then I add a big equity risk premium because it's a Turkish company, I think I'm double counting country risk. First, by pushing up my government bond rate into my risk-free rate, and second, by having a higher risk premium.
Thank you very much for this clear-cut information, Professor. And actually, we can continue on this inflation issue. As the COVID-19 hit the world, you write an article about inflation, about the financial asset classes and how does inflation affect these financial asset classes. And in my blog, I have also summarized this article of yours, but the world realized it now. It was months ago, and months ago means light years ago in this changing world. Could you please explain again, how does inflation affect our stocks valuation, and how does inflation affect financial asset classes?
It's not inflation per se, it's unexpected inflation. I'll give you an example. If inflation were 10% and you are guaranteed that it'll be 10% a year forever, it's not a problem. Here's why. We can index everything to inflation, right? Your pay will rise by 10%, your tax will be adjusted, everything will be locked in. The problem with inflation is when it becomes high, it also becomes more volatile. In other words, the uncertainty you face about inflation is far higher when you have 10% inflation than when you have 1% inflation. And when you're uncertain about inflation and you own financial assets, stocks, bonds, even real estate where you're collecting rents, if inflation is higher than expected, you're paying a tax, right? Inflation is a hidden tax. Because if inflation is higher than expected, you might get the pay that you contractually are promised, but it's worth less because inflation was higher than expected. So historically, unexpected inflation has been terrible for financial assets. So in Turkey, you have had experience with inflation. So you know how much damage inflation can do to financial asset classes. In the US, the 1970s were the last period of high inflation. It was deadly for stocks, deadly for bonds, deadly for financial assets. It used to be that real estate was relatively unaffected by inflation. But as we've securitized real estate, even real estate has started behaving like stocks and bonds. There's no safe place to hide from inflation. And I think in a strange way, it explains why Bitcoin is trading at $57,000, why NFTs are being bought and sold for thousands of dollars. Because if people don't trust financial assets, and real estate is no longer the haven that it used to be, the question is, where are you going to put your money? It used to be gold, but there's only so much gold that you can invest in. So I think part of the reason cryptocurrencies are so attractive to some people is if you believe inflation is coming back across the board, across the world, the place to go is something that's not a financial asset class. Cryptocurrencies, collectibles, paintings, and NFTs.
Mm-hmm, mm-hmm. I completely understand. And it is very great to speak with you because every sentence brings me another idea. And recently, Şant Bey had set the tone in Turkey in one of his videos very high with this stagflation issue. And as you explained, in the 70s, there was a high inflation, but at that time, there was also a growth. So recently, Deutsche Bank has also made a survey with 600 professionals, and the results were widely discrepant. So how would you define stagflation, and how stagflation affect the stock valuations?
I tell people, look, you don't have to define it. You know it when you live with it. You know how you know you have stagflation? Is the minute you get currency, you get paid in currency, you know what you try to do? You try to convert the currency into something else. Because currency loses value while it sits in your pocket, right? So you put 100 lira in your pocket. If you have 50% inflation, you better get that 100 lira and convert it into something else as soon as you can.
As stocks
So
work?
during hyperinflation, during the German hyperinflation, people used to buy groceries with their money because lettuce held its value better than the currency did. You know, the Venezuelan currency has knocked 6 zeros off the currency because they've had so much inflation. They just took 6 zeros off. You thought you had $1 million. You wake up the next day and you find out you have $1 because it took 6 zeros out. That's what happens when you have stagflation. People just lose faith in your currency. They will hold anything but your currency. And I think that's what you have to worry about with stagflation is you debase your currency. People lose trust. You will never be able to borrow long-term. You will never be able to issue long-term bonds. You will never be able to raise equity in that currency because people just don't trust the currency. It's very difficult to get that trust back. I mean, that's why I think governments choose to default rather than go into high inflation. It's easier to come back from default than it is to come back from debasing your currency.
Before giving the ground to Arzu and Onur Bey, I'd like to ask one more thing in this issue. So can we think about cryptocurrencies as we said, they have no intrinsic value, we cannot value them, they cannot generate cash, so they are not investment class, but they're a kind of collectibles. Is it the reason why they are now popular?
Maybe. I think that could be the reason a lot of people hold on to cryptocurrencies because they've lost faith in fiat currencies. So think of it, I've described Bitcoin as millennial gold, which is if you're 25 or 30 years old and you panic, you don't want to buy gold because that's what your parents and grandparents did. You buy Bitcoin or Ethereum. So I think that there is an argument to me. The only thing to keep in mind, though, is gold has had staying power. It's been around thousands of years. Bitcoin has been around 13 years. So if you put your money into Bitcoin as a collectible, you better hope it's not like Beanie Babies. Remember when Beanie Babies were collectibles? These little toys that people used to collect 20 years ago because they thought that they would hold their value better than stocks or bonds. There are people with attics full of these stuffed toys waiting for them to come back. No, I think you got to worry that's the worry you have with cryptocurrencies is you don't know whether this is a collectible with staying power. And the more cryptocurrencies that enter the game, the more you worry about this, because then you might have 100 cryptocurrencies. You don't know which one is going to be the one with the staying power. You're making a bet.
Thank you very much for this lovely conversation, Professor. Now I'll check the audience questions, and Arzu, it's yours.
Yes, so still we have some time. So talking about cryptocurrencies, I just want to add and ask Professor Damodaran, in the long term, do you think cryptocurrencies are trustworthy for investors?
Do you think the Turkish lira is trustworthy for investment? I mean, you could ask this about any currency. Why is it just cryptocurrencies? Because a fiat currency, what do you have? You have a piece of paper that the government says has value. It's a piece of paper, right? If you lose faith in the government, that piece of paper just becomes a piece of paper. So all currencies are built on trust. Fiat currencies, the trust is in the government. With cryptocurrencies, it's in a computer algorithm. You know what? There are a lot of people who'd argue that computer algorithms are more trustworthy than governments are. So I think rather than ask, are cryptocurrencies trustworthy, you can ask that about every currency. So I think what we need to think about here is, how do you create a cryptocurrency where there's lasting trust, where you know that people want. Right now your worry might be, if I buy Bitcoin, what if somebody can go in and change the algorithm to remove the upper limit? Bitcoin is an upper limit of 21 million Bitcoins. You can't go above that because but a computer algorithm is just lines of code, right? So if somebody can change the code and make it 210 million Bitcoin, all of a sudden it becomes deflationary. So I think with cryptocurrencies, the question is, how do you build lasting trust in the computer algorithm that underlies your cryptocurrency? But I would say governments face the same threat. The more governments misuse their power to print money, the less you trust them. Venezuelan bolivar is a useless currency now because the government has no trust. Nobody in Venezuela holds Venezuelan bolivar anymore. They'd hold anything but Venezuelan bolivar. Fiat currencies are built on trust in government. So if you worry about cryptocurrencies and trust, you should also be worrying about fiat currencies and trust.
Okay, Professor Damodaran, thank you for your answers. And I will pass the speech to Mr. Onur if he has something to, some questions for Professor Damodaran. Onur Bey, sorularınız var mı Professor Damodaran'a?
Teşekkürler Arzu Hanım. Yes, I have some questions to Mr. Damodaran. First of all, thank you for your time to be here with us, with our community at YouTube. As a very well-known and very well-respected professor in the field of finance. Before jumping into my question, I would like to give some context. Of course, during my time, during my college years, both undergrad and master degrees, I've read your books, of course, a very well-respected book for me. And I have a master's in financial engineering, so one can say I'm a numbers person. And our job at Gedik Investment is to help everyone to basically facilitate their investments through our investment platforms. And we also invested more than 100 startups for the last 7 years. Most of them are in Turkey. Some of them are outside of Turkey doing great business. And I understood the importance of narratives here, doing investments on my own. But I would like to understand your perspective, and I would like everyone to understand your perspective, is when we meet a new company, their founders and management, which procedures and steps do you follow, or do you advise people to follow? Because this is not a holistic way of thinking, but in order for everyone to understand better, of course, if they read your books, they will understand it. But in short, can you please summarize?
I think when founders describe their own businesses, they tend to get very excited about their ideas, which makes sense, right? You have an idea to a business, you want to describe the idea. So every founder describes the idea. So if it's a technology business, often it's a software person who's describing their idea. They tell you how great the software is, how amazing the features of the software are. But the questions I would ask that person are questions about whether they can convert the idea into a business. I mean, let's start with a very simple question that I ask founders with great ideas. How do you plan to make money? That's a simple question, right? If you're a business, ultimately, you could at least think about how you plan to make money. You know how many founders' stories stop right there because they haven't even thought about it. They say, I haven't thought about it yet. Have you, so if you've written this great software, do you plan to sell it? Do you plan to have a subscription business? Do you plan to have an advertising business around it? Tell me at least that you've thought about this process, because you can't wait and think about this 2 years later or 5 years later. So if your business has lots of users and subscribers, I'm very impressed. But tell me, do you make money of these users from subscription fees? Do you make money of these users by having advertising on your site? So I'm interested to see if they're capable of converting their ideas into businesses. They don't have to, I'm not looking for certainty, because how can they give me certainty? It's an idea still, but I want them to at least tell me that they're thinking about how to convert this great idea that they have into a business. I also want to make sure that they're the kind of people who will take help. Let's face it, none of us has the power to be able to do everything all the time. So if you're a technology person, you might need help on marketing, on supply chains. So I know I want them to be the kinds of people who will open the door and say, okay, come in and help me, without letting their ego get in the way. So those are the kinds of probing questions you need to ask, is find out whether this idea can become a business, because as an investor, you don't make money on ideas. You don't make money on users. You make money on businesses ultimately generating earnings and cash flows.
Thank you for your answer. And in addition to that, of course, we have seen in Turkey, probably when we invest in 100, probably we saw around 1,000 startups to invest in that 100. But of course, our team probably saw more than several thousands. If you, in mathematical terms, or what is most critical? Is it the idea, or the market, or the founders itself, the capability of them? Of course, in each sector, this differs, but probably when it's a technology company, if we go on that subject.
I'm sorry, you've become muted.
I have become muted, or the translation might have stopped. Can you hear me now?
Is it me or? Okay, now I can hear you. Okay, go ahead.
So let me repeat myself. So basically, when you value a company, which values are the most critical ones? The founders, the idea, or the stage they're in, the market itself, the country, or if it's local? Can you please comment on that as well?
Well, I think very early in the process, the founder is the most critical ingredient, because there's nothing else, right? There's a person standing in front of you. And let's face it, if you don't trust that person, everything else becomes irrelevant. So often when you meet a person, sometimes you know right off the top that this is not the person you want to invest in. You don't trust them. It might be gut, it might be instinctive, it might be intuitive, but it's not the kind of person you want to be a partner with going forward. But once you've made that choice of going with a person, then you're probing deeper to see, hey, let's face it, if you're in a country with a lot of country risk, you want to make sure the founders thought about ways in which they can protect this idea no matter what happens to the country. That's tough to do, because they have enough on their plate and you're saying, hey, worry about what the country will do. But without that protection, you can have the greatest idea on the face of the earth. And if the country goes to hell in a handbasket, so does the idea, so does the company. So I think that early on, the person matters the most. As you move through the process, the idea matters, then the business. So it's almost like you move through stages, where you worry about different things at each stage, and you've got to have different skills at each stage.
And if we move on to publicly listed companies, so founders become probably diluted. There are corporate investors, individual investors in the company, and there are professionals in the company, and there is the idea and the market. And how do you value, again, in these terms?
Your life gets a little easier because you now have a history to base. I describe this in the following, and as a publisher, you might relate. It's like coming into a book in chapter 19. There are 18 chapters already written. You know who the characters are. So it means that when you tell the story for the company, it's going to be based on what you already know about the company. So if you gave me Coca-Cola to value, it's not like I can come up with any story I want and make Coca-Cola into a technology company. It is a soft drink company. It's a beverage company. I know where its value is coming from. Same thing's true for ExxonMobil. So the more a company's been around, the longer its history becomes, the more your story is to be grounded in that history, which makes things a little easier because it means that you're telling a story with a lot of foundation to it. It also means that if 10 people look at that company, their stories are going to be pretty similar because they're building off the same base. In contrast, if I come to you with an idea company, you're in chapter 1, 10 different people look at the company, they can tell you 10 very different stories, which means their valuations can also diverge a lot more.
For beverage companies and ExxonMobil, you are correct. But what if, and in your book, you summarized, for example, for Twitter, they had a business model, they are publicly listed, but for a long time, they become negative in terms of EBITDA or anything in that matter. Or for Amazon, I think for 18 years, they were in negative side until they become cash positive. In these processes, I think that, as you say, the values differ and what you value in the company differs. But how can you project, even if it is a publicly listed company, the terminology changes. For some company might be there for 100 years, but it might be there for 20, and you never know what happens in the next 20 years if it's in the field of technology.
You can't let uncertainty become the enemy of trying to make estimates, right? Because you sit there saying lots of different things can happen that I can't control. You will never value companies. The reality is you take the information you have at the time that you have it, you make your best estimates for the future, and then you tell yourself, I'm going to be wrong 100% of the time. Why? Because you're not God. And here's what you also tell yourself. If I'm wrong, I'm going to come back and change my story. Leave the door open. You're not done. When you value a company, this is not the end of the story. This is just a continuing story. Whereas the company reveals more about itself. As the world changes around you, you get a chance to revisit the company. I valued Amazon every year since 1997. The stories change. I've loved every time I valued the company because this is a company with an ever-changing story. It's a story where I feel more comfortable now than I was 24 years ago, but it's been an evolution. So I would say that almost every company I value, I never value a company and then abandon it because I'd come back to it a year later, 2 years later, 3 years later, because I'm looking to see, has anything happened that'll lead me to change the story, to tell a different story for the company. And it also means I'm not beating myself up when I'm wrong, because it is part of the process. You are going to be wrong, and it's okay.
Thank you for these great comments. Last, any advice to storytellers which might be listening to us, CEOs, co-founders, or investor relation departments, to tell their stories better in the subject of the book as well?
I would say don't get carried away. Sometimes telling a bigger story can get you a higher price as a company. So many founders say, let me tell the biggest story I can. The problem, though, is you then have to deliver on that story. So you got to think about not just what can I say, but what can I do? So as a founder, think about what you can do and then tell a story where you can deliver on that story. And one reason I like to use Amazon as my example is it's a company. But Jeff Bezos has told the same story for 25 years since the founding of the company. And he's delivered every part of that story every step of the way, which means he stayed consistent. And the reason the market trusts Amazon so much is because they trust that there is a story here and the story is staying consistent. Most companies, the CEO tells whatever story is convenient for the moment. Or you want to be in social media, we're a social media company. Next year, you're something else because you're trying to keep up with the market. And after a while, people don't believe you because you just make up stories as you go along just to keep the market happy. If you have a story for a company, you got to believe it. It's got to be authentic. It's got to be a real story that you can deliver on. It's not just a fairy tale. We are telling investors to keep them happy and give you a higher pricing.
Yes, this is, I think, the most critical stage of our century, because every day we hear a new story and people tend to create new stories in order to get some valuations, higher valuations might be. But they might get it because there is negative, we are in an environment where there is a lot of money pumping, and of course, now it's stabilizing, of course. But as you say, we should not get advantage of it, but get trust of them is most critical.
The way I describe it, there's a sucker born every minute. So there are lots of suckers out there. And guess what? I don't shed any tears for them. I'm not going to stop them. A fool and his money are going to be parted sooner rather than later. So I don't spend time worrying about, hey, what can we do to prevent investors from falling for these stories? Because guess what? Nothing you do will stop greedy people from setting aside their questions and investing in something because they want to double their money. This is as old as time. When governments say we're going to pass regulations to protect these people, all I tell them is go back and read history. Human beings are hardwired to be greedy and sometimes overreach. And guess what? You can't protect people from their own mistakes. Let them feel the pain, and the next time around, maybe they will learn their lesson.
Thank you for these answers. I'm passing the stage to Arzu Hanım, and thank you for your time and for my answers, for my questions. You really answered them pretty honestly. Thank you.
Thank you.
Professor Damodaran, thank you for joining us.
Is it just me, or is the audio kind of?
I think she had a problem with the audio.
Yeah, I think it's a problem on your side, because my Wi-Fi I'm checking looks good. So
I can ask a question from audience while we are waiting for Arzu Hanım. The audience is happy actually, and they are thanking you for being with us and answering the questions. And they're also saying that they're also saying that you know the Turkish market very well, Professor. And one of the questions is, people are using filters to select stocks, and they're asking, how do you select the companies that you would like to value?
I am not a portfolio manager. I'm not a financial advisor.
Şimdi soru cevap kısmına geçiyoruz. Sorularınızı YouTube chat bölümünde.
Yes, they are muting Professor stages.
Okay, perfect. Okay. So so from that perspective, the way I describe things is I value companies because I find them interesting. Now, I'll give you an example. I valued Paytm, this Indian payment processing company that's going public. Why did I do it? Because I was curious. I wanted to see why people were attaching a $20 billion value. Now, for the most part, when I invest in a company, it's because I got interested in it after a news story or reading something about it or reading what other people were saying about it. Say, okay, I'm just curious. If I were a portfolio manager, I couldn't get away with this, right? I'd have to be more systematic. And that's why most portfolio managers are given a universe that they invest in. You can't invest in anything you want. You have to invest in this grouping of stocks. Now, thank God I'm not a portfolio manager because I don't have to follow those rules. No, so I invest in things, and at this stage, my portfolio is stable enough that I don't need to add 50 companies a year. If I can add 2 or 3 companies a year to my portfolio, I'm perfectly okay. So I'm in no hurry to go out and find something cheap in the next 2 weeks. I think one of the cautionary notes I would offer to people who are in a hurry to invest is slow down. You don't need to find a cheap stock in the next 2 weeks. If a company is cheap, waiting 2 months is not going to make it somehow get out of your horizon. So slow down, take things incrementally. Don't be valuing things just because you think they're cheap, because you're going to be wasting a lot of your time.
Thank you very much. I understand pretty good. Arzu Hanım, is the connection again good?
No, I don't think so. It's still, I think. No.
Okay, then I'll continue with another question. And actually, it can be a follow-up question. Another person from the audience asks, it's a personal question, of course, and I know in the book there's a paragraph about that, but they're asking about your valuations and your investments. Do you make investments on your valuations? And if so, how successful they are?
That's the only reason I'd value companies. If I didn't invest in them, what's the point? Am I successful? I mean, I invest only my own money, my family's money. Nobody's fired me yet. No, and I'd have no qualms about firing myself if I thought I could make more money on index funds and ETFs. And remember, that is your real choice. It's not whether I want to invest my money with somebody else. It's whether I want to kind of go back to living my life and let my money make whatever the market makes. And I'll say something that's not going to make a lot of active investors happy. For 90% of people, the best path is to not try to value companies and pick great companies, but to just put your money in an index fund or an ETF and go back to living the rest of your life. Be a doctor, be an engineer, be a plumber, make your living. You know, you invest to preserve and grow your wealth. You don't invest to get rich. And that's why I've always approached investing. So far, I haven't hurt myself by going out and picking stocks. But then again, I don't take stupid risks. I don't put all my money in 3 companies. I don't try to double my money on a stock. So by not overreaching, I think I reduce my chances of doing something stupid, because when you overreach is when you do stupid things that can really hurt your portfolio.
But anyway, we as humans try to believe, as far as I know from Vale investment, we would like things to be good. And if we cannot go out at the right time, we can be more sorry for our investments, I guess.
Nobody wants to be average. Everybody wants to be above average. Everybody wants to beat the market. But the problem is somebody's got to be average. That's why it's average, right? So I think it's a reality we all face, that we all want to beat the market, but it's really, really difficult to do.
I think we found a gold mine here with this valuation question, because now I have more other questions. One of them is my question. Some people, when do make valuation, keep the stocks forever, even the price passes the valuation. So how is your approach on that? And the second question is, what would be your margin of safety for this valuation and price difference?
I think my margin of safety, let's take the margin of safety question first. Well, first, it's not one number. It can't be the same number for Apple as it is for Palantir or a young growth company. It's got to vary across companies, reflecting the uncertainty you face. And second, if you're going to buy something because it's undervalued, and that's your philosophy, how in God's name can you then say that you're going to hold that forever, even if the price goes 100% above the value? I think consistency alone demands that if I buy something that's cheap, I should sell it when it gets expensive. But I'm not going to sell it the minute it gets above the value. I'm going to sell it if I feel that it's got enough above the value that I can't hold it in good conscience. It's true that I'm quicker to buy than I am to sell, because there are tax consequences I have to think about when I sell something. But in general, I think that you need to sell something when it gets significantly overvalued, just as you would argue that you'd buy that same thing if it becomes undervalued.
Mm-hmm. I understand. And another question is about this, that I don't like. Probably I will not like the answer, but I'll ask. With macro forecasting, how is your attitude about macro forecasting? And with ExxonMobil, you actually tell in the book, are we so good with the macro forecasting? Should we buy stocks or do something else?
I'm going to give you a nuanced answer. We're really good at macro forecasting. What the heck are you doing valuing stocks? Right? If you're good at forecasting the price of oil, go buy oil futures. It's easy to make money. So when people claim to be good at macro forecasting and they're trying to value companies, my response to them is, if you're telling me the truth and you're really good at macro forecasting, why are you wasting your time valuing companies? I'm not good at macro forecasting. I know I'm not good. And sometimes knowing what you're not good at is as critical as knowing what you're good at. I don't try. I don't try to forecast interest rates. I don't try to forecast inflation. I don't try to forecast oil prices. because I know that I'm not good at it. So I don't try. And because I don't try, every one of my evaluations, I take what I call a macro neutral view of the world. And whether it works or not, I think it's up to you. You have to decide what you think about your macro forecasting skills. But don't assume that just because you pay somebody a lot of money to get macro forecasts, that you're getting good forecasts.
Mm-hmm. That's true, exactly. And one question is about these supply chain problems. Will they, or according to your opinion, are these supply chain problems create a stagflation risk for US economy or in global economy?
I don't think they can create stagflation, but they can create inflation. Stagflation requires too much money. You need printing. Nobody's ever had stagflation because supply chains broke down. You're going to have high inflation, whether it's 6 or 7 or 8%. We'll find out soon enough whether it's transitory and COVID related. And I think there's a case to be made that at least some of them, and how much of it is long-term. There's a structural problem. And the structural problem might come from the fact that so many of our supply chains around the world are dependent on China for some part of the supply chain, that if there is a break in China, this is a long-term problem. That break could be a political break, an economic break, a tariff break, whatever it is. So my concern is some of these supply chain problems are long-term problems. And those long-term problems are not going to go away. And that's going to create some upward pressure on inflation, not just for the next 2 months or 3 months, but maybe for the next few years.
Mm-hmm. I agree. And I think Fed has a point. Everything, all in all, at some point is transitory. Arzu, are you good and with us again with the connection?
You're muted.
Beni duyabiliyorsunuz. You hear me, right?
Yeah, I can hear you now. Yeah.
Yes, so Professor Damodaran, thank you for sharing your opinion with us. Thank you for your answers and your time.
No, you're welcome. It was my pleasure.
O zaman şimdi soru cevap kısmına geçiyoruz.
Now, at this point, we go over to the Q&A session that is over, but you can always ask your questions still from the YouTube chat section. And before that, we have a surprise that we have already announced at the beginning of the broadcast. I'm going to ask you a question which you will be able to answer very easily. The question is the following. Name the one Aswath Damodaran book published by Scala Publishing, sponsored by Gedik Investment. Name one Aswath Damodaran book. So the correct answer, you can give the answer to by posting it as a comment under Gedik Yatırım's post in Instagram, and the 10 people who will post the correct answers will receive an autographed copy of Aswath Damodaran's latest book. So please post your answer as a comment under the activity post in Instagram. The winners will be announced from our Instagram account at Gedik Yatırım. I hope it's not a very hard question. It's a great question.
During this time,
do you have any questions, Mr. Topaç?
Yes, I have another question, Mr. Damodaran, if I may.
Sure.
I mean, we are in a world now that it's really hard to forecast, as you said, the macro perspectives as well. But in your perspective, what are the challenges that might might affect the valuations of the publicly listed companies in the near future? As you said, we are talking about, actually, Mr. Ergun Bey asked about stagflation risks or higher risks of energy. What is your opinion about, if you think about a long, I mean, 3 to 5 years, maybe not next year, but of course, maybe a prolonged period of time?
I think the biggest risk is we're all connected at the hip. Welcome to globalization. I mean, you probably heard of Evergrande, the Chinese real estate debt company that's been having issues for the last few weeks. And as it's been having issues, the entire global market has been going through contortions. That is the way the world is going to be. There was a time where if you're a Turkish investor investing in Turkish stocks, all you cared about was Turkey. That's no longer the case. Every one of us is affected by the rest of the world, which means get ready for rolling crises, right? Because if you know, if you think about just the last 12 years, you had Greece and then you had Ukraine, and I mean, each year you seem to have a different crisis that you had to deal with. And people said, experts said, just wait for this crisis. Once it's over, we're going to go back to a nice, solid, stable life. Well, good luck with that. I think the reality is we live in a world of rolling crises, which means if you're a business, you got to be able to think on your feet. You got to be dynamic. You can't have a static business model. And in 2020, we got a reminder of why businesses need to be flexible and adaptable. And I think that's a lesson hopefully we can take out of this and make all businesses more flexible and adaptable going forward, because we will need that skill.
Yeah, you're right. The Evergrande, I think it's like over 300 billion US dollar, and now more are coming, I think, because they're, as you say, it's a domino effect. Probably it's coming if this happens. I hope it's not. I hope that don't have.
Well, it's not quite Lehman, so I wouldn't worry about it like I did for Lehman. It's not the kind of entanglement. But my point is more simply, here you have a Chinese company that makes all its loans to other Chinese companies, and the rest of the world is worried about it. And you're saying, why would that be? Because, you know, what happens in China doesn't stay in China. It affects every one of us. What happens in Turkey doesn't stay in Turkey. It affects all of us. So in a sense, you know, it is the nature of globalization, is one country's problems very quickly become everybody's problems.
Evet. Ergun Bey, size gelen sorulardan yöneltmek istediğiniz var mı? Hem Profesör Damodaran'a
Would you like to ask more questions, Ergun Bey? Well, I have many more questions for Mr. Damodaran.
Do you have a new project, new book from your side in English? And after your answer, I have also a couple of questions. Which book of your Damodaran's are you going to translate next one? So
I would say investment philosophies.
Yes.
Because it fits into what Onur was talking about of, you know, if you really want to get investors to think seriously about investing, you need to have a philosophy. And what that means is, to be a good investor, you don't need to understand how Warren Buffett thinks or how Peter Lynch thinks. You need to know what makes you comfortable and uncomfortable. That's what that book is about, finding the philosophy that's right for you as a person. Are you patient? Are you long-term? Are you somebody who wants to go with the herd, do what everybody else is doing? These are things that you can't change. And finding a philosophy that best fits who you are as a person, to me, is the most critical part of becoming a good investor.
But audience should wait at least a year for that book. That's one of the great books too, but we will wait. And from your side, are you writing a book in English?
I'm always writing. I never start off writing a book. I just write. And often when my writing gets to a critical mass, I hand it to a publisher. So I don't enter a contract, because I don't want to feel under the obligation that I've signed a contract to write a book and therefore I have to write a book. I write because I have something to say. If I don't have anything to say, what's the point? Why write? You know, why? There's enough stuff out there, right? I have no desire to talk for the sake of talking, write for the sake of writing. So maybe one day I'll wake up and say, I have nothing new to say. Everything that I have to say is out of me, in which case, you know, I'll feel perfectly comfortable walking away. So whether it'll be about ESG or whether it'll be about pricing or whether it's any of the things. So that's the advantage of writing on my blog, is it lets me put down on paper or online what I think about something at a point in time. And if it's something that's passing, I never come back to it. But there are topics I keep coming back to. And at some point, I've read 8 posts on a topic. You bring them together, that's 50 to 60 pages. I'm already a quarter of the way to writing a book. My narrative and numbers came out of a blog post in 2013 on valuing Uber. That was where it started. It started with a 4-page post that became a book of several hundred pages. So who knows? No. If it plays out, it becomes a book. If it doesn't, I'm not shedding any tears. It's okay. It was not meant to be.
As a good student of yours who is interested in reading your articles, your blog, I'll be keep watching. And if not, I'll start it back again.
Absolutely.
So, Arzu, I'd like to have the last word later on, but for the moment, I have no questions and no particular questions from audience.
Okay, so sanırım bu güzel sohbetin sonuna yaklaşıyoruz.
Well, then this brings us close to our closing. Professor Damodaran, thank you so much. Onur, Topaç, Ergun Unutmaz, thank you for this conversation. And we'd like to thank the audience for being with us. Have a great evening. Onur Bey, Professor.
Their lovely answers. And I hope our audience get the most out of these books. And good evening to all.
Thank you. It's my pleasure.
Herkese katıldığı için çok teşekkür ediyorum. Bizi izlediğiniz için.
Thank you. Thank you for being with us. Thank you for watching us. And Professor Damodaran, thank you for being with us, for your invaluable insight, and also for having Turkey, all these valuable books. And thanks to his translator, Ergun Unutmaz. Thank you, Arzu Hanım, also for the moderation. And I'd like to thank the interpreters too.